With that being said, is there any form of forecasting of commodity risk, like we would forecast the financial exposure, like we would forecast cash flow management? Do you forecast commodity risk as well when you budget your year, for instance?
Yes, typically that's a very well, it's a very challenging area, just like it can be for forecasting foreign currency risk or doing a cash flow forecast in the treasury environment. So we're facing here the same type of challenges because you're never better than the quality of the data you get in. So if you manage to get proper sales forecast from your sales team, then you can turn that into a production forecast from your plant. You can define at which capacity level your plant will run. Based on that, you can imply how many megawatt hour of energy you need to consume, how many tons of input you need to put into your factory, and what's the seasonality thereof it should be. And based on that, you can essentially try to say, okay, this is my exposure profile for, say, next year. And based on your strategy, which might be to fix a certain percentage up front or not, you might start entering into a commodity hedging practice. But again, the source is really defining what the exposure is, and very often, well, that needs to come from a forecast somewhere or other. So we're of course exposed to variability of these forecasts, the fact that they change, forecast to forecast, are changing regularly. You're also exposed to the fact that for operational purposes, a company might decide to use plant in Spain instead of a plant in the south of France from one day to the next, just because, I don't know, there is a strike or there has been a flood somewhere. So you might wish to change your plant. But if you stop producing your product in the south of France, you stop being exposed to the gas price in France, and you increase your gas price exposure in Spain, which is not the same index. So essentially, you're exposed to a lot of specificities of the commodities market, which are somehow hard to manage, but that's what makes it fun as well.
Yeah, there are so many things at play that you would at first maybe not imagine, but like indeed, like to just make your whole company work around a specific commodity. I don't know if you're very specific on something, but then you also need to think about the gas and the electricity and the water for the cooling machines or whatever it is. It very very quickly becomes so intricated. That's super cool.
Yeah, absolutely. And if you want to push it even further, you could also come up with some strategies which you can take advantage of. For example, let's say that you're supplying a certain raw material from two different suppliers, right? There's two suppliers that can supply your plant with a certain material, say, I don't know, aluminum, right? If you manage to agree on two different pricing mechanisms with these two, without being bound by too much volume commitment with each of them, you can arbitrage between the two prices at the moment of doing the call-off in order to buy the product. So at every point in time, you can say, well, depending on the pricing formula, depending on your volume commitment towards each of the supplier, you can promote a bit more supplier A versus supplier B or the contrary in order to take advantage of the differences in the pricing formula that you have.
That's super interesting, and yeah, and pushes your suppliers to remain competitive as well when you're in such a formula. That's pretty cool.
Absolutely, yeah. And yeah, and if you want to, well, we touched upon some specifics of the commodity market, but there are other, and there is something I'd like to share with the audience, which is some kind of framework, and that's the way we like to analyze it. When we speak about commodity risk, it's sometimes difficult to determine what commodity risk really is. And we like to look at it through two different axes. The first one is the risk direct or indirect? Let me give an example of a direct risk. You're buying gas, right? You buy gas, you pay gas. You pay the gas price because that's what you buy. For an indirect risk, typically, you could buy a transport service. You buy the service for transporting your product from your factory to the final client, and you pay the price to a transporter for that. As part of that transport contract, there is a high probability that you will have a diesel indexation clause that will end up making you pay more if diesel price goes up, or pay less if diesel price goes down.
Ah, it
In
goes
this
that way as
case, we have
well.
an
Good.
yeah, exactly. So Well, it depends on the contract, but majority of such type of contract would go both ways, indeed. Um, in that case, you have an indirect exposure. So that's the first axis, right? Are you directly exposed to the commodity or indirectly exposed? The more indirect the commodity exposure, the more hidden it is. So if you speak to people, so buyers or risk managers or treasurers within companies, typically they will first focus on the direct because that's what's most visible. That's the tip of the iceberg. And if you start looking into indirect, there might be some exposures which are very, very indirect. So very hard to detect. So that's the first axis. The second axis is the exposure explicit or implicit? And that's also very important because typically you might buy, well, in our gas example, I'm speaking here about an explicit exposure. I buy gas, so that's a direct exposure, and I buy it on the gas index. That index is black on white in the contract. It's explicitly exposed to that market index, right? If we speak about an implicit exposure, I might buy, say, a chemical product, which I know is manufactured based on oil products. It's a derivative of oil products, but there is no market price for that one. In that case, the buyer will typically let us know that every time he goes and negotiate with its chemical product supplier, if he sees that Brent moved up, he will end up paying more. If Brent moved down, he will have a bit more negotiation power to negotiate down the prices. Right here, we are in an implicit exposure. And then, of course, we have a third category there, which is the not exposed. So typically, if you buy a laptop, well, your laptop is built out of many different types of material. You have a bit of gold in there, you have plastic, you have, well, you name it. Most probably, the price of your laptop is completely independent of the price of the sum of its components. It's a little bit the same as the example of the beer we gave earlier. Well, if you buy a beer, most probably there will be somehow in the long run an impact of the commodity prices in there, but you cannot really claim that it's a direct exposure and that it's a direct pass-through. It's not because the brewery has paid its gas a bit more this year than last year that it will sell beer at a higher price, because that's more the commercial strategy. And here we're getting a little bit away from my area of expertise, but it's more a commercial strategy that you don't want your product to be perceived as the sum of the commodities, because it might play in your favor when prices are going up. But when commodity prices go down, you don't want to be caught in a situation where all your customers come knocking on your door to ask for a rebate just because the cost of energy went down.
Right. So that's why you're saying in those industries, typically you'd have actors who are very well aware of this dynamic and will make sure to either hedge or take a hit when they feel they will need to take a hit, but they won't be reflecting this on the final price of their product.
Absolutely. Yep. And you can take the airline industry. That's quite speaking as well to many people, because in the airline industry, there used to be no practice for a long period of time. There was no practice of price pass-through. There was no fuel surcharge for a long period. Then I think that was in 2008, if my memory is not too bad, we had a significant increase in oil prices, of course, then in jet fuel prices as well. And then you saw some players in the market introducing a fuel surcharge to their client so that, well, they were immunized against the price increase because they were just pushing that risk to the final customer, to the people buying the plane ticket. Some others did not follow and just took the hit. Some others left their plane on the ground because they were not sufficiently hedged and the jet fuel price was too high so that it was actually eating up all their margin and even creating negative margin if they would fly. So you had a panel of different reactions to such market movement.
Yeah, and I think so. This industry that you specifically point is like the perfect example, because now it's a report that dates a bit, so it's like back from May 2023. But Ryanair did exactly this. They are apparently best in class when it comes to commodity risk management, especially the fuel, engine fuel. and they made, I think it was 1 billion return on investments on their fuel hedging, because it was skyrocketing back at the time of Russia and Ukraine. Well, still the case, but when it bursted out and like everything explodes on the markets, but they were hedged, and they saved 1.4 billion euros thanks to hedging 80% of their fuel budget. So there are some industries where it can have a significant impact, and directly on the bottom line as well. Talking about examples where Treasury can really make the company earn money by not losing it. That's spot on it.
Yeah, that's exactly that. And if you push a little bit further, and well, I've been working in the past for a couple of airline companies, and what's striking is that very often the first question when it comes to determine the hedging strategy is not so much what is our risk and what should we do, it's what are the others doing. And that's very interesting, because here we are caught in a kind of game where some companies, but then it depends also on the company, but some companies, and speaking probably more about the charter here rather than the flag carriers, but typically on the charter side, they operate on a cost-sensitive market, so they cannot afford being higher in price than the competition, otherwise they just don't sell any seat anymore. So they prefer being wrong together with the other, for example, not being hedged in a market that goes up, rather than being caught with a hedge at a too high price when the market goes down, because if they're the only one in such a situation, they will end up with higher ticket price than competition, and their plates will be empty. The question of the strategy here is fairly important. We had like other clients in other industries where they were literally looking at the correlation of their main market with the main economic cycles, because typically if energy prices goes up, it usually means, well, political turmoil plays a role, of course, like we see today, but we usually see that when energy prices go up, it means that the economy is rather booming, and then they know that they can increase their price because there will be demand for their product. In some other cases, so in that case, what they will end up doing is that they will just say, okay, I'm not hedging everything. I can live with a significant open position, because if I pay more, I know I have the capacity to pass it to my customer because demand will be there. So it's a very, very interesting topic to come up with definition of the most appropriate hedging strategy around commodities. And you see, just like for FX, it also very much depends on the risk aversion of senior management within the company and, of course, of shareholders.
Often it's indeed down to that. What are the typical tools and systems that you see, Olivier, when it comes to commodity risk management? Because some treasurers out there might have some names in mind, but for instance, I have no clue what tool is used to do commodity risk management. So what do you see as being the main tools around that space?
So if we're speaking to treasurers, there are for sure a few names that they will know, which are the big players on the treasury management system industry, which well, both of them are speaking about FIS and ION. Well, both of them have their commodity risk management product. We have other players as well. So there are a bit more than a handful players there. You can name Kaios, Orchestrate, ECA, SAP also has its commodity risk management module. Well, you need to do, if you want to engage into a process of selecting the right tool, there are plenty out there on the market. It really depends on what you want to do, what commodities you're being exposed to. Some have their limitations, some are by nature multi-commodity, some others are more focusing on the one or the other commodity. So you really need to do a little bit a tour of the market, see what are the strengths and weaknesses of these different vendors to assess what's the best fit for you. Just very, very similar to a TMS selection project, I would say.
Right. So it would just be about finding a tool where you would eventually link to your ERP, I guess, where you see, okay, how much of a certain commodity is purchased on a certain defined period of time, and then linking it to their index and their price and say, okay, that's how much exposure we have. I guess, is that about it?
Yeah, that could be the basics of it. And then, of course, you come up with all the side questions. Some of them are typically commodity related, like if I enter into a portfolio of commodity derivatives, how will I make sure that the accounting picture that gets out of it is appropriate and is also in line with what I want to show to my shareholders and to the market? So that means probably how do I make sure I apply hedge accounting? And it's already a challenge to apply hedge accounting to foreign currency or interest rate derivatives. It's another ball game for commodity derivatives, because then you're speaking about other criteria such as the own use exemption to make sure that essentially your profile of consumption matches the profile of your derivative, and so on and so on. So there are a number of complexities around it which needs to be overcome. And essentially, if you don't have a proper system to do that, it's a big challenge.
Yeah, makes sense. Okay, so if I were to summarize, when it comes to commodity risk management, and if that's something you listening to this right now are looking into, the first thing to do is to properly understand your situation. Like even before entering into any form of hedging or what type of derivative do I want and so on is, okay, what are the commodities that we are looking at, that we know of, and eventually that we don't know of? That's where people like you, Olivier, come into play, but we're going to get to it in a second. So understanding your situation, seeing what commodity you're exposed to, seeing what's the actual life cycle of the product manufacturing or whatever this commodity becomes within your walls, and then what comes out of it. So the whole sales and pricing strategy. And once you have this kind of as is, then you can say, okay, that's how we're going to tackle this type of commodity, which might not be the same strategy for this other type of commodity. Sometimes we're going to do a proxy. Sometimes we're going to do any of the other terms, fancy terms that you mentioned, Olivier. But is that about it? Or how do you finalize a commodity risk management strategy exactly?
Yeah. So your first point, I think, is spot on. So understanding the exposure is the first thing. Once you have that, you need to sit down with senior management and define what you want to do about it. So that's the strategy. So how do you define the strategy? You can say, well, I know my market, I know my competitive position on that market, and that's what I want to do. I can accept a certain degree of risk. I know I can pass through to my customers. There might also be difference per market. Some clients of mine, for example, in certain areas, decided not to hedge in certain cases because they were really a price setter on their market. So they could say, well, that market, I can remain fully open because I know I'm on the price setter. So if price goes up, I have full ability to increase the prices, which was not the case on another market geography. So there might be different approaches to that. When it comes to once the strategy is defined, you need to define as well how you're going to put that into practice, how you're going to walk the talk. So it means that, and there are different ways to operationalize it. You have the price pass-through, we discussed it. You can also engage into discussion with your supplier base. You can try to modify the way you price your final products. You can try to align just the pricing frequency or the timing of the repricing on the one hand with the other hand. You might have more strategic initiatives, like typically vertical integration. Say you're buying a commodity from a certain supplier, you might just decide to vertically integrate so that you're not so much exposed to price fluctuation on that market because you bought that company. You might also have other strategic initiatives like the 3R, which we very often speak about, which is reduce, reuse, and recycle. So if you're significantly exposed to the price of copper because you have a certain number of wires in your product, well, maybe you can re-engineer slightly the product, reduce the length of the cable, and you reduce your exposure in that way. So there are plenty of things that are really outside of Treasury that can be done before we enter into the discussion about, okay, the remaining exposure that we have, we've tried everything. We are still sitting with a certain amount of exposure. For that one, we need to manage it with financial derivatives. So the way I see it is that Treasury or the usage of financial derivatives comes really last after having explored all the other possibilities, because using financial derivatives, just like it's the case for foreign currency or interest rate, will not make you escape the market. It will just allow you to buy time. It will allow you to, well, eventually delay a price increase to the market or make sure that you have changed your way of producing or that you change your supplier and so on. But you will not escape the market with financial hedging. That's true for FX. That's also true for commodities. So once you have that, the next step is to say, okay, how do I make it work in practice now? So you've defined your your exposure, you defined your strategy, what you want to do about it, with which tool, and now we need to say, how am I going to do that? And that's where you probably need to look into a system if you have significant number of different exposures, if you want to hedge with financial derivatives and so on. So that's where you need to look for the right system. That's about it for the way I would tackle a project. Very high level, but that's typically the big steps I would take, starting from scratch to define the right approach around commodity hedging.
That makes lots of sense. And I think I spoiled it a bit when I mentioned Ryanair earlier. But do companies, once they enter into a form of hedging strategy, Olivier, do they typically hedge 100% of it? Would it be more like a certain percentage of it? How does it typically work?
It really depends. Let's say that for companies who want to apply hedge accounting, very often they need to hedge what we call the highly probable portion of the forecast. And very often highly probable that means not 100%. So a lot of companies who want to apply cash flow hedge to their commodity hedging strategy will then hedge a little bit less than the 100%. But then, of course, a very common strategy, just like in foreign currency, is also a decreasing hedging profile, so that you would hedge a bit higher, say the next quarter or the next 6 months, and then have a decreasing profile. And that also allows you to have a layered strategy where you progressively enter into hedges that pile up in order to hedge a certain period, which essentially end up exposing you not to a certain price point in time, but to the average of the different price points you picked when you entered into your hedges.
Right. That makes a lot of sense. So, Olivier, you know...
Again, here, no one size fits all. No one size fits all.
Yeah, that's usually, unfortunately or fortunately, that's usually how it ends up. But so, Olivier, you know a lot about commodity risk management. So, for those who don't know, can you maybe tell us a bit about who is Auto Finance and what you guys do over there?
Yeah. So Auto Finance, it's a Belgian-based consultancy firm. We're specialized in treasury and risk management, and it's as part of that risk management that we ended up having quite a lot of assignments in the area of commodity risk management. Our client base is essentially Belgium and the neighboring countries, but we also serve the rest of Europe. We've been founded by myself and a colleague of mine, both ex-Big Four, and we're about 10 consultants at the moment.
Yeah, we have some roots in common, if I understand properly, Olivier.
We do.
Could you walk us through how you would typically, I guess that kind of summarize what we've discussed until now, but how would you typically strategize, monitor, and execute a commodity risk management project for your clients?
Yeah. So I think we discussed a lot of these different steps, but to summarize, it's one, understanding the exposure and then understanding the risks that are created for you in terms of bottom line as a result of these exposures. Defining the right strategy. So defining a strategy that matches the most your aversion to risk, your competitive position on the market. Once you have the strategy, it's getting the right tool to be in a position to monitor the evolution of these risks, to record your portfolio of financial hedges if you decided to enter into financial hedges, or if you decide not to hedge, still to monitor the risk. I mean, it's not because you decide not to enter into financial derivatives that you need to stop monitoring your risk. So that's an important item as well. And then it's setting up the KPIs, because we didn't discuss that neither. But here again, there is no magic answer to what KPI should I follow, but there are a few different things that are done here and there by some companies, which we can take some inspiration from. It's always easy in commodity market, just like it is in the FX market, to do backward trading. So to say, oh, you should have bought at that time, it was the low point.
Yeah.
So,
Thank you for that advice.
But and then that's why we tend to avoid these type of KPIs, because these KPIs you will always end up being worse than these KPIs. So what we try to do from time to time is, for example, I know a company which calls its KPI the monkey. And the monkey is essentially a mechanical hedging strategy, where you compare the result of your risk management department, taking the decision about when to hedge, and you compare that to a mechanical hedging strategy, which says, for example, every 15 of the months we buy X% of our exposure for the next 12 months. And there you say, well, the salary of the guy in the risk management department is it worth in terms of added value that this guy or this lady is bringing? Um, is it worth it because he has delivered some additional value in comparison to a mechanical hedging strategy that would take 2 minutes to someone to execute every
Right.
15th of the month?
So that's an interesting one. And actually, so speaking of KPIs, but overall, how to pitch a project like this? I mean, for a consulting firm, but also as a treasurer, right? Because so I've been in this room is something I would like to say, but it's not. But I know how it goes in the room together with the CFO, right? When you pitch a project, at the end of the day, it's also going to be about okay, but what's the impact bottom line? So how do you typically pitch for a project against commodity risk to the C-suite and the boards and so on? Like, how does that feel like?
That's a great challenge because, as we were mentioning earlier, the main challenge is to identify the right person to speak to within the company. If you speak to the chief procurement officer, it might not necessarily be the right person to speak to because in its KPIs, it's possible that the guy or the lady has not the price risk management out of market price in their attributions. So it's possible that we need to go back to the CFO, who is not necessarily directly in charge of these risks. And there needs to be a combination or discussion between CFO, Chief Procurement Officer, in order to determine that, okay, we have a risk here. We recognize that we have a risk. We recognize that it's potentially not really well managed today because we have no one in charge of that risk. And once that first step is done, they probably need to agree on an organization that needs to tackle and manage these risks. It might be sitting under the procurement, like we have in some of my clients. It might be sitting within treasury, like we have with other clients. So there, again, here, no right or wrong answer. It depends on how well these different teams are staffed. It depends also on the capabilities and how close to the market they are. So there is no right or wrong answer here. There are only specific cases. And in some other cases, you have a specific risk management department. So if we go back to our original example at the start of our discussion, which was the energy producer, well, managing gas and electricity price risk, which we call the spark spread, is their core business. In these environments, it's not within procurement, it's not within sales, it's a specific department which takes care of that. When the risk is a little bit more diluted, like we have in many corporates, manufacturing companies, there it's probably worth getting the risk out of the responsibilities of the different person on the buy side, on the sell side, and setting up a specific department to manage this risk with dedicated people looking after it on a regular basis and reporting to Chief Procurement Officer and CFO.
And if you don't know where to start, well, reach out to Olivier. Olivier, thank you so much for coming on the show. Anything you'd like to add to the different topics we touched upon?
Well, no, it was a real pleasure to have a chance
Likewise.
to speak about this fascinating topic with treasurers, because in the end, even if treasurers cannot do that alone, treasurers are an important part of the team that need to tackle these risks if we want to do it well, because we need to capitalize on their knowledge of the market, of the financial market, on their knowledge of the application of hedge accounting and so on their proximity to the CFO. And there are lots of similarities between the management of the other financial risks and the management of commodity price risks. So capitalizing on their knowledge, on their ability to manage these risks is something which is rather essential. So that's why it was really a pleasure to address this topic today with you.
Well, thank you very much for this. If people want to learn more about you or auto finance, where should they go, Olivier?
Well, they can look at the website. We have the description of our services over there, where you'll find something about commodity risk management in there. And you'll find all the contact details in case you want to continue the discussion in one-to-one.
Amazing. We'll put all the links in the description. Olivier, thank you so much.
Many thanks. Speak to you soon.